Hello and welcome to On the Record. I'm Mark Dreyer. Troubles in the Eurozone continue to make headlines, with open talks of a Greek exit and fears of contagion, plus uncertainty in the new Franco-German relationship. I sat down recently with Martin Feldstein, a professor of economics at Harvard University and one of the more vocal critics of the EU fiscal compact. He previously served as the chief economic advisor to President Ronald Reagan and was considered a leading candidate to succeed Alan Greenspan as chairman of the Federal Reserve in 2005. Feldstein is known for being a fierce opponent of the single euro currency since its formation back in 1999. Earlier this year, amidst the brewing crisis in Greece, he reiterated his position, describing what has occurred as an inevitable consequence of imposing a single currency on a very heterogeneous group of countries. Feldstein has also questioned attempts at an EU fiscal compact to address the current crisis, predicting it will be no more than a mild agreement between countries to balance its budgets over the business cycle. Now we've heard talk of QE3. What's your view on whether it will happen and whether it should happen?
It's easier to answer the second of those questions. I don't think it should happen. I think that what we got from QE2 was exactly what Ben Bernanke predicted. It had the impact of raising share prices. Share prices were strong at the end of last year. That led to more consumption, again, as Chairman Bernanke predicted. But it was one shot. So it really didn't carry over into the year that was 2010 policy, and it just didn't give us any real growth in 2011. The first quarter GDP growth in 2011 was so close to zero that it might as well have been zero. It was 0.1% in that quarter. So I think we're adding to the balance sheet of the Fed, we're adding to the overall liquidity of the economy without any real payoff in terms of increased GDP or increased housing demand, housing construction, new home sales were down. So I think they're adding to their problems without getting any real payoff in terms of the recovery.
Now, if QE3 was to happen, it sounds like you don't think it would have any sort of long-term sustained impact on the economy, but in a short term, would it be effective at all? Or?
You know, it was short-term 3 months in 2010, so that's just not worth doing. The danger is it adds to the ongoing problems, and it doesn't really do anything significant for the growth, for employment.
And what's your sense, although it's hard to predict, of course, what's your sense about whether it will actually happen or not?
Well, they're talking about a new way of doing it. So first they did straightforward QE. They just did open market operations, bought long-term, put out essentially cash, which the banks then turned around and redeposited at the Fed. And that's why it hasn't been inflationary, or indeed why it hasn't been much of anything other than putting some downward pressure on long-term interest rates. And now they're doing Operation Twist. So instead of building up cash or bank reserves, they're substituting treasury bills. Well, you can only do that until you run out of treasury bills. So they've now told us that they're running out of treasury bills. They're running out of short-term paper. So the new idea is for the Fed to create its own IOUs. So not a deposit at the Fed, but the equivalent of a treasury bill, only issued by the Fed rather than issued by the Treasury. But it's really all the same thing. It's all super short-term liquidity. It doesn't matter if you're a commercial bank and you have to wait a week or even a month to exercise your right to put that piece of paper back to the Fed. It gives you complete liquidity to do other lending. So I think it continues to make for a risky situation in the future.
Now, economics, particularly at this time in the political season with the election cycle coming up, is always increasingly more political with all the different elements involved. Who do you see winning the election? And either way, how would that affect US fiscal policy?
Well, it looks like, and again, I'm not an expert on vote counting, but the people who do that seriously say that the Republicans are likely to maintain their position as the majority party in the lower house, the House of Representatives, And it looks like the Republicans will gain the majority in the upper house, the Senate, but by a small margin. So maybe 52-48, 53-47, something like that. What that means is that they'll have enough strength to pass legislation. Yet it will all depend on whether the president wants to sign that legislation. At this point, the betting in the United States is that President Obama will get reelected. So we may well find ourselves with divided government. White House in the hands of a Democrat, Congress in the hands of Republicans. That's going to make it hard to deal with what needs to be done: broad-based tax reform, reform of the entitlements. What makes it much more serious as a problem now is that the current law says that the tax cuts that were put in place early in the decade and renewed in 2010 expire at the end of this year, expire at the end of 2012. So that in the January 1, 2013, without any action on the part of the Congress, those tax rates are going to jump. That jump is very big. We're talking about 3% of GDP. Well, a 3% of GDP increase in taxes would push the economy into a recession. There's just no question. It would be a very deep recession if that were allowed to happen. Now, nobody's going to want that. On the other hand, with a split between the White House and the Congress and very little time to act, if President Obama does get reelected, accidents could happen, and we could find ourselves. And not only that, if you're a businessman today in 2012, and you look ahead and you say, you know, that could happen. We could be in a recession. I could be facing much higher taxes. Well, that's certainly not a reason to go out and invest. So you're likely to hold back on investment, just as consumers are likely to hold back on disposable consumption spending.